Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Are you looking for some real estate strategies as a real estate investor? Are you looking for some tax strategies that actually work these days? Well, if so, we got the guest for you today. Thomas Castelli is zooming in from Miami, Florida, and Thomas has a ton of experience not only with taxes, because I believe he is a CPA, but also working with us real estate weirdos, whether you're doing short-term rentals or if you're into multifamily syndications. Thomas has some tips, tricks, and strategies that will help you save money on taxes. Thomas, welcome to the show. Great to have you.
Hey, thanks for having me again, Dave. It's an honor to be here today.
Yeah. So give us a little snapshot about who you are, what you do, and who you help.
Yeah. Long story short, I'm a certified public accountant and tax strategist, and we help real estate investors basically reduce their tax bills, streamline their accounting, and make sure that they're compliant with the IRS, and also help with cost seg studies. So we work with real estate investors across the U.S., as little as one property, all the way up to syndicates, funds, and other large scale operators.
So how did you decide to really laser focus in on real estate investors as your target avatar?
Yeah, that's a great question. So the firm that I work for, Hall CPA, they were already in real estate, and I think that kind of just developed out of a natural curiosity in real estate. I believe the founder of our firm started answering questions on Bigger Pockets. And that kind of just led to some clientele. For me specifically, I was investing in real estate a little bit myself when I was kind of coming out of the tail end of my college career, right before I started my first full-time job in real estate. In a CPA firm. But when I got to the CPA firm, I kind of realized the entire corporate element of it, like the audit stuff, really wasn't for me. I was more of a tax guy. And I said, okay, well, how can I take the accounting background and the real estate and combine it? So that's when I found Hall CPA, and the rest is history. It just made sense to do.
All right. So Thomas, let's start off with the mom and pop real estate investor. They've got a few properties, maybe it's short-term rentals, maybe it's single family home rentals. Mm-hmm. The mom and pop side of things. Right now we're recording this in 2026. What are some things that those kind of investors should keep in mind or be aware of when it comes to minimizing their tax burden?
Yeah. Okay. So I think there's two things here, right? So the first thing is going to be that all real estate is passive by default. Rental real estate. And what that means is you can't take the losses from your rental real estate, usually generated by depreciation. We can unpack that however much we want. But you can't take that against your W-2 income or active business income from another business that's not real estate. There's a few workarounds to that. So a lot of people just get confused by that. So by default, you're not able to do that. The good news is it can help you offset the rental income you're generating from your rental properties and potentially gains on the sale of rental properties. So you can use those losses. But the big question a lot of people ask is, okay, well, how can I actually use these losses to offset my W-2 income or my business income to generate significant tax savings? And there's two primary ways to do that. When we're talking about long-term rentals, we are looking at the real estate professional status. So to qualify as a real estate professional, you need to spend more than 750 hours and more than 50% of your total working time in a real property trade or business. So you basically need to be working full-time in real estate. Now, the benefit is if you're married, let me back that up real quick. So the challenge is with the real estate professional status, if you're working full-time, through tax court cases, IRS, it becomes almost impossible to qualify if you have a full-time job elsewhere. If you're married, your spouse can qualify and you file a joint return, well, then you both benefit. So that's one option. But what's been really popular, I'd say really since 2020, but what's gained another resurgence after the passing of the One Big Beautiful Bill and they renewed 100% bonus depreciation, was short-term rental investing. And that's because short-term rentals, they fall under a different part of the tax code. And that is treated more like a hotel or a motel. And there's an exclusion that if you have an average period of customer use of 7 days or less on your short-term rental, that it's not a rental property, it's a business. And in a business, you don't have to spend more than 50% of your total working time to take the losses. You simply have to materially participate, which is a much lower threshold. There's 7 tests, but the one that's most relevant for most people is going to be spending more than 100 hours on the property, but making sure no one else spends more time than you. So that's been a highly effective and popular strategy for the mom and pop investors are looking to benefit from the tax benefits. But I want to caveat all that to say is that if you're just investing in rental real estate and you're able to shelter the rental income that you're generating from tax, that in and of itself is very powerful. And I think a lot of people overlook that, overlook the effectiveness of that, because you're not getting a major refund in 1 year. It's like a slow burn every year. You're adding more and more rental income that's sheltered by tax. You're reducing your effective tax rate because you're not paying more taxes on that income, if that makes sense.
No, unwrap that a little bit more for me, if you would, Thomas.
Yeah, absolutely. The best way to do is
let's walk through an example for example. Let's
for sure.
One if you want.
That's the best way to do it. I'm just going to use round numbers here. These are not actually going to follow the tax brackets. But let's just say that you're a high income earner, you're making $500,000 a year, right? And you're paying $200,000 in taxes. Your effective tax rate, which is going to be your tax liability divided by your total income, is going to be 40% in that example. A little on the high side, but it's 40%. Now let's say that, over time you're able to generate $50,000 of rental income that's sheltered from tax, meaning you're not paying tax on that rental income. Well, assuming everything else being equal, you now have $200,000 of taxes, but now $550,000 of income. So we're going to take the $200,000 of taxes and we're going to divide it by 550. And now your effective tax rate is 36.3%. So effectively, you're becoming more efficient with the income sources that you're generating, because you've generated more income, but yet you've not changed your tax liability. Here in this example, I'm oversimplifying it, but the point of the matter is, like, you're actually, because you're driving income from a tax efficient source, you're actually, in theory, driving down your tax rate.
Okay, got it. All right, so that's for like the mom and pop real estate investor. Now, what about the syndicators, the fund managers, the folks that are doing multifamily deals or industrial deals or own mobile home parks, self-storage facilities, that kind of stuff? How do you work with them?
Yeah, absolutely. So that is like a whole other ball game over there. And there's a whole bunch of things you can do within the actual syndicate and fund structures to make sure it's optimized from a tax perspective. But as a general partner, your biggest tax savings tool for you personally would be the real estate professional status, because usually what happens in syndicates and fund structures, you're going to have a promote, you're going to have a portion of the deal, whether it be 20, 30% or whatever combination you have there, is going to be what you own in the deal. And usually that comes with part of that is going to be the depreciation benefits are going to flow through to you. So you're going to have these losses, these paper losses that you can, if you have the real estate professional status, you can use to deduct against your other income. So that's going to be the main thing that real estate syndicators and fund managers are going to want to focus on if they're full-time in the business. That's a major big unlock. The other thing is carried interest, which is really interesting. So in most businesses, you're going to pay tax at the ordinary income tax rate on the profits of your business. But when you're a syndicator or a fund, that promote, that 20 or 30%, when certain requirements are met, is not taxed at your ordinary income tax rates. It's taxed at capital gains rates. So ordinary income rates are up to 37% at the federal level. The carried interest at the capital gains rates can be up to 23.8%, but could be lower than that in some cases. So there's significant savings just by focusing in on the carry interest component of it, which is a major unlock for people who are syndicating deals. And that's just not just for real estate, but it's any type of private equity type offer. But real estate investors, of course, get the benefit from that. In fact, there's a carve out. Normally you have to hold this for 3 years historically in order to, after the Tax Cuts and Jobs Act in 2017. But for most private equity deals or hedge funds, but real estate is explicitly carved out from that. So you don't actually have to hold it for 3 years to get that treatment. There's a few other requirements, but long story short, being in real estate gives you some additional tax benefits towards that angle.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Okay, very good. So with your business, Thomas, who do you typically work with on a day-to-day basis? What is most of your clientele made up of?
Yeah, I would say we have two divisions of the firm that we work with. So one of them is individuals and small partnerships. So it's the people who are investing in short-term rentals, or maybe they're building a portfolio on the side. Short-term rentals are really popular right now just because of the tax benefits. So you see a lot of high income earners gravitate towards that, which is why I mentioned that. But on the private equity side, it's syndicates and funds. It could be people who are just getting started with their first syndicate, or people who are established and have multiple syndicates under their belt, or people who are jumping into the fund world where they're, I've done my track record of single asset syndications, and now it's time to go raise a blind pool fund and go do that route. So really, I'd say it's those two buckets, and that's what we primarily see on each of those two sides.
Okay. No, that makes a ton of sense. Very, very cool. So, Thomas, tell us a little bit about where you see your company going over the next year or two. I know some folks in the multifamily space have taken a real kicking over the last couple of years. What does your crystal ball tell you about the situation, or what do you see with your clients on that side of the fence?
Yeah. So that's a great question. So yeah, multifamily has definitely been had some ups and downs over the last few years. But we still see people dealing in the multifamily world. Other people have gotten more into commercial. We've seen some people do more senior assisted living facilities because the demographics and the supply and demand factors around that particular asset class has been favorable. So we've seen that. I think the biggest thing that's probably going to change though is actually not necessarily on the real estate side, but AI. How AI is going to impact accounting firms, but not only accounting firms, but just people in general. And it's already impacting the way some people do stuff on the real estate side, from my understanding. But I think AI is really what's going to be the game changer. It's going to enable a bunch of different services to be provided that weren't really practical before, or at least at an approachable price point, because over time, a lot of the data entry, a lot of the transactional work that you would see in accounting, like bookkeeping and tax preparation, will be largely automated. And then it's going to allow professionals to focus on the advisory element of it. Like, how can you reduce taxes? How can you improve your business? And we're going to see more stuff around that, which I think what a lot of people really want, but oftentimes we're bogged down by the transactional nature of the current landscape that we're currently in. But that's soon to evolve.
Well, that brings up a good point. So how do you see AI benefiting your business? Because it sounds like it might be a little bit of a threat on one side, opportunity on the other. It sounds like you're more of a positive glass half full kind of guy.
Yeah.
Where do you see the big benefit of AI coming in for you?
Yeah, I really think what it is right now, a lot of clients, right, spend money on the transactional bookkeeping work or the tax preparation, and that eats into their budget for what they could dedicate towards the financial aspect of their business, if you will. AI is going to be able to reduce that cost effectively. I don't want to say to zero, but to a much lower price point than what's able to be offered today to a large extent. And that's going to open up the budget for people to be able to pay for the advisory services, which is what actually helps them grow their business, what actually helps them reduce their taxes. So I think once a lot of that stuff is automated, the price point's lower. It's just the value of what CPAs can provide in general from an advisory standpoint is going to be much greater.
So why, if you foresee people using AI to do their basic bookkeeping, even their year-end type stuff or big chunk, but why wouldn't they use the AI as an advisor?
That's a great question. There's a few reasons. So at least as of today, AI, and we've ran through so many AI models and tested so many things, is good at giving high level information, especially from a tax perspective, but often either hallucinates things and makes things up. I can't tell you how many times we asked it for tax court cases and it gives us stuff that doesn't exist. So you have to be, and there was actually an audit where an attorney gave the tax court, this actually happened, fake tax court cases that didn't exist and as support, and they figured it out. But the point is, I think what it is, AI is not completely there to piece together the full picture and all the details and nuance. And on top of that, I still think people, especially on the financial side of their business or their life, are going to want somebody who's an expert in that space still to be there to navigate the waters. So in other words, they might know that, hey, AI can do this, but how do I know AI is doing it right? How do I know everything's being facilitated properly? And that's still where they'll tap into the expert. Like, okay, I know that we're going to use AI for this side of the business, but I want you guys to run it because you guys understand the financial side or, tax side, whatever have you. I still think that human element, that trust in humans, is going to be there for a while. I think it's going to be hard to replace that, at least from what I've seen with AI. Even as far as advanced it has came, I just don't think it's fully there yet. I don't know when it'll be able to bridge that trust gap.
Yeah, no, I don't know if it will, to be honest with you. And especially those hallucinations are so frustrating. That's for sure. Because it just confidently tells you exactly what it thinks you want to hear, kind of thing. Very, very good. So, Thomas, as we're kind of wrapping up our conversation here, let's look at two sides of things. So, for the mom and pop real estate investor, at what point is it a good idea for them to reach out to you or somebody like you to get some outside input on their tax situation because of where they're at with their portfolio?
Yeah, that's a great question. And it kind of depends, but to give some like loose guidelines around this, I'd say that when you get into real estate, you're getting a little bit more advanced in terms of, if you came from an H&R Block or TurboTax or your local CPA down the block, that all works if you just have a very, very simple tax situation. And it can actually make it seem deceivingly simple sometimes. But when you get into real estate, the tax code is a lot more nuanced. There's a lot more margin for error. There's a lot more judgment that has to be involved, and a lot more of like piecing together multiple intricate pieces to fully unlock the whole picture. So I would say that is as soon as you're starting to get into rentals, like as soon as you're like saying, hey, I'm going to buy one, you have something under contract, or you're about to close on your first property, that's probably when it makes sense to engage, have a conversation with a CPA who specializes in real estate in order to, see what they could do to help. Because like I said, the learning curve on the real estate side is quite high. And just a lot of generalist CPAs out there don't have it, and there's just a lot of mistakes that could be made if you let it go too long without having someone take a look at it.
Okay, and then on the other side, if somebody's already doing syndications, if they're already kind of in that fund world, at what point does it make sense to get a fresh set of eyes to take a look at things from an objective perspective?
Yeah, that's a great question. I would say, I mean, it's hard. If you're aware of things breaking down, that's definitely a time to have that conversation. Or I would even go as far as to say, if no one's ever given you real estate, given you any tax advice, and they've kind of just filed your tax returns, that's usually when it makes sense to get a second opinion. Because what a lot of CPAs do is they'll just do the tax return and they'll never give you any advice on how do you optimize your entity structure? How do you optimize your promote? Can you qualify for the real estate professional status? How do you handle the fees that you're getting as a syndicator? From a tax perspective, a lot of people gloss that over. And also on the legal side of things, when you're looking at the operating agreement or the PPM, there are tax sections to those operating agreements. And a lot of times attorneys, they do a phenomenal job at asset protection and liability protection, and really covering yourself from the legal side, but they don't always handle the tax elements of those correctly. So I can't tell you how many times I jump on a phone with a syndicator and like, oh, we're going to do this from a tax perspective here in this syndicate. I'm like, okay, cool. Let's look at the operating agreement. The operating agreement says something different. And the operating agreement is the governing document. So I would say things are breaking down for sure. Definitely makes sense to have a conversation. But if no one's ever like looked at your operating agreements from a tax perspective, if no one's ever looked at your promote structure and how you can optimize yourself and the syndicate overall from a tax perspective, from that angle, probably makes sense to have a conversation on that. That's what I would say.
Fantastic. Hey, Thomas, if they want to have a conversation, what should they do?
Yeah, if they don't have a conversation, the best way to do that would be go to the realestatecpa.com, and there's a link to book a free consultation. That's there. That would be the best way to do it, to fill that out. Or you shoot me an email at thomas.castelli@hallcpallc.com, and you get the conversation started that way.
Very good. Thomas, thanks for being on the show.
Thanks for having me.
All right, everybody, take care, and we'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.